Well, today's average sales price here in Delaware is about $325,000. So that's about $125,000 in equity. That's awesome. So let me walk you through a game plan on how you can use that equity to make your financial future, well, just a little bit brighter. So in this example, let's say you walked away with $125,000 in equity, but $25,000 of that was used as fees as part of the sale of your house. So really, you got $100,000 here. That's awesome. Congratulations. Now, how can we take that $100,000 and put you into a much better financial position and into a new house? First thing is, with the purchase of the next house, let's say you used an FHA loan and the house was $400,000. That's a 3.5% down payment, or about $14,000. So that $14,000 is automatically out of that $100,000. And let's say the seller covered your closing costs. We are seeing that happen from time to time here in the state of Delaware. So we now have $86,000 still remaining. That's awesome. What else can we do? With that in mind, we have $86,000 remaining, and most home buyers, when they get into that next house, the mortgage is going to be exponentially higher. If you purchased the house several years ago for about $200,000, your mortgage was roughly $1,200 a month, versus today's mortgage at $400,000, probably looking closer to $2,800. That's a difference of about $1,600. And what if I told you there's a way to actually make that difference smaller? According to bankrate.com, the average American is spending $700 plus a month on their auto loan. So what if we took that $6,000 we had laying to the side from the sale of your house and paid off your car loan? That obviously is going to save you money every single month. Not only the fact that you don't owe that money, but you're not going to be paying that crazy amount of interest on that auto loan anyways. So with that in mind, that $1,600 we were worried about is now below $1,000. A little easier to handle, isn't it? How else can we save money though? Well, according to annuity.com, the average millennial American has about $5,000 in credit card debt. So imagine we took some of that money you made from the sale of your house and we used that to pay off the debt, thus you're not having to pay it back, which is nice, but also saving you probably a couple $100 every month on the monthly payments to those credit cards. With all of that in mind, you've been able to pay off your auto loan and pay off your credit cards and still have about $50,000 left over. That's pretty exciting. Not only does that put you into such a good position for your financial future, you have money there that you can use to start your next business or go on vacation or to help you pay that additional $800 a month you weren't prepared to pay for in your next mortgage. And I'll be honest with you, most millennials, like myself, we typically move because we've had kids, so we need a bigger house. Or we might need to move a little closer to family because some of our family members are getting sicker and we're looking to try to support them. The good news is you're able to sell your current house, buy another one for a higher price point with a higher interest rate, but still be in a much better position financially and in a house that is much more comfortable for you now and likely for the next 3 to 5 years. So if you want to keep learning some more tips, make sure you keep watching. Or if you're curious about starting this process or what it might look like for you, hit me up in the DMs. I'm here to be of service. And until next time, guys, keep on being awesome.